So the primary advantage of using the IRR method to evaluate capital budgeting projects is that it results in decisions that will maximize income, is easy to understand and communicate. I think this is what we discussed, easy to understand and communicate. Results in decisions that will maximize income. I don't
Hello.
think because, hello,
Hello. Yes,
hello,
sir. Still not visible.
screen is not visible. I've already shared it. I've shared the screen.
It's not showing anything.
Again, it's not showing.
No.
I'm again sharing 2 minutes. See, I'll show you something.
Mm.
See, I've already shared the screen. I'm sending the screenshot to you. I don't know why the screen is not visible. See, you can see on WhatsApp, right?
Yes, sir.
Hello?
Yes, sir.
Yeah, I'm sharing once again. Can you see the screen now?
Yes.
You can see right now.
Yeah.
Okay. So the question is in front of you. Can you try to answer?
C assumes a conservative reinvestment rate.
Sorry? Yeah, see,
C.
I will tell. See, the primary advantage of using IRR method to evaluate capital budgeting projects is that results in decisions that will maximize income. No, never. See, what IRR tells the rate at which your NPV is zero, right?
Yes.
That means your present value of cash inflows is equal to present value of cash outflows. Where is the matter of maximizing? It shows the break even. Point number one. So this option won't go. It only shows the rate at which you will break even, right?
Yes.
Your present value of cash inflows will be equal to present value of cash outflows. So that gives us the clarity that the first option cannot be. And I think this is easy to understand and communicate, right? Because if IRR is more than the cost of capital, we select the project. So easily it can be understood. Assumes a conservative reinvestment rate. What does it mean? It shows that the reinvestment can be done at IRR. The cash flows what you get can be reinvested at IRR, right? This does not mean that it is a conservative rate.
Okay.
For every project, IRR may not be the same. Results in decisions that will maximize, no. It relates to the first one only.
D,
Just
sir.
go for this question. Yeah. They're asking you based on the information, what is the initial investment for DCF analysis of this proposed upgrade? They're asking you the initial investment. Try. There are three things you should be knowing when you are finding out the initial investment amount. Okay. Those three things are initial investment, has three components. The three components of purchase are purchase of new equipment. This is the first component of initial investment. Second, increase in working capital. Third, if at all you are replacing, like, there are two things here, existing equipment and new equipment, right? So there may be a case whereby you will be disposing, hello?
Yes, sir. Hello.
Yeah, there may be a case you will be disposing of your old equipment. So you will be getting some proceeds or money from that. Okay. So after tax, cash flow from disposal of old machine. These three things you need to consider. So the first one here would be the purchase of new equipment. Am I right? Is it right?
Yes. Yeah.
What can be the second one?
Increase in working capital by adding account
There are two
receivable.
things here. Working capital is nothing but it is current assets minus current liabilities. It is net current assets, right?
Yeah.
So we have current assets here, current asset here, sorry, current liability here. So what we will see, there is a change of 2000 in this, correct?
Yes.
That is increase in receivables, and there is a increase in payables. How much? 400.
400.
The difference happening to be 1600. So we got the second one also, right? Yes.
Yes, sir. Hello.
Now, yeah, now the third element is to find out after tax cash flow from disposal of old machines. So, company is considering an equipment upgrade. The company uses DCF analysis in evaluating capital investment and effective tax rate is 40%. Selected data developed by company. They have given the market value and they have given the current market value. Okay, so that means the existing equipment what they had was costing them 50,000. The accumulated depreciation what till date was 45,000. That means if they sell the asset today, they are going to get how much?
3,000.
Hello, 3,000, right? So in this, the book value is how much? 50,000 minus 45,000. The book value is 5,000, right? This is the book value. This is the book value which you are showing in the balance sheet after deducting the accumulated depreciation from the original cost, correct?
Yes.
Now we will do the calculation. Proceeds from old equipment. That means what you can get. Tax effect.
40%.
Salvage. Yeah, yeah. So the final value what they can get is 3,000 only, right? Salvage value 3,000. This is the final value what they can get. Less book value will remove 5,000. 2,000 is what is the loss, right? Right?
Yes.
5,000 worth asset can be sold at 3,000. There's a loss or there's profit? Hello?
Loss.
See,
Loss.
this is, yeah, this is what you're going to get. This is a cash inflow, definitely. But what we are saying is whether we got a profit or loss. If there is a profit, we'll pay tax. If there's a loss, we will get a benefit, right? If we are paying tax, we'll net. We will remove that. If we are getting benefit, we'll add. So 5,000 worth of asset is sold at 3,000. There's a loss of 2,000. So into tax rate 40%. So 800 is the tax benefit, right? This will be added up to 3000. So the total 3800 is the value we are getting from the after tax cash inflow from disposal of old equipment, right? So third thing also we got. So first thing was 95,000. Second thing was 1600. Third thing is 3800. So can you tell me the answer? So this is 3800.
1,400,000.
No, you have to do the calculation. This we have to remove because this is disposal, right?
Yeah.
Disposal of old equipment. We are selling it.
92,000.
We are selling. Sorry.
92,800.
Yeah. See, our agenda is to find out the the like they have asked us to find out the initial investment, right?
Yes.
On zeroth period. But one thing.
Just hello.
Yeah. Just a second. See, this is a investment, right? It is what cash outflow, correct?
Yes.
Right or wrong?
Yes. Right.
This is also increase in working capital. This is also a cash outflow, not decrease. So these two, when I take positive figure, I have to take this negative figure because this is an inflow, correct?
Yes.
These two are outflows, right? This is inflow. So I have
If
so
we hello,
yeah.
if we get positive 3,800, then we have to add, or in just because of inflow we have to deduct only.
See, of course, these two are outflows. This is inflow, so you have to deduct only, right? Nullify them.
If we get positive value also.
It's positive only. You're getting a positive value only. There's no negative value. When you sell equipment, you get positive value, right?
Yes. But here we got 2,000 loss, no, sir.
Yeah, that loss is of no matter for us. Loss is not a cash outflow or inflow, right? We are just calculating the benefit, tax benefit out of that. We will get we consider inflows and outflows, not accounting income or losses.
Okay.
Did you understand?
Yes, sir. Yes.
Sure, right?
Yes, sir.
So what is the answer now? 92,800. So very cautiously you should be doing. So these two actually, if I put in brackets, this is positive. So at the end you'll get a initial investment amount. Shall I move forward?
Yes, sir. I'll note it.
Yeah.
Can you scroll up, sir? Done, sir.
Next question. You have to find out the anticipated IRR. Dr. G invested $10,000 in a lifetime annuity for his granddaughter Emily. It's like perpetuity they are saying, right? And the annuity is expected to yield $400 annually forever. What is the anticipated IRR? So what is the formula for IRR? What is your cash
Present value
outflow? Yeah, present value of cash outflow is 10,000, right? Is equal to,
of present value of cash inflow.
yeah, present value of cash inflow. Present value of cash inflow. So now 10,000 10,000 IRR is the discount factor at which your present value of cash inflow is equal to present value of cash outflow. Either we can do one thing. We can, this is the investment, the that's going to give them $400 annually forever. Okay, so this is the point of perpetuity. At what rate? Okay, so perpetuity, what we'll do is we'll take cash inflow divided by R. What we'll do?
That's divided by amount.
We'll take cash inflow divided by R. That is the formula for perpetuity. Okay. Okay. So 10,000. This is forever, right? So what is my cash inflow? I'm going to get 400 divided by R. That is going to be my IRR. So this implies R is equal to 400 divided by 10,000. You're going to get what? 4%, right? Hello?
0.04. Yes, sir. Hello.
Yeah. Shall we move
Yeah.
forward if you note it down?
Yes, sir.
Shall I move forward?
Yes, sir. Yes.
That was the question of perpetuity. So company uses IRR method to evaluate capital projects. The company is considering 4 independent projects with the following IRRs. 1, 2, 3, 4. Company's cost of capital is given. Which of the following project options should company accept based on IRR?
And C, option C.
Why?
Here, cost of capital
Here
is
the
13.
two, yeah, both the IRRs are
Are
more
greater.
than
More.
13%, right? So C
Yes.
option. Very good. Both the IRRs are more than the cost of capital. Next, 60th question. Last question of this section. We'll move to next section now. We have done a lot of things, almost done in this. So you should be going for the next questions.
Hello.
Yeah. I'm here.
A is the method of funding the project.
Yeah, it does not affect that. But why? Yeah, project salvage value, initial cost, all this
Working capital.
have an impact. Yeah, sensitivity, in sensitivity analysis, if this changes, then this also can change, but this does not matter. See, you can take debt or equity, whatever it is. You can start the project, doesn't matter, right? So we will start next section. What section we shall take, we will see. So we are done with this. We are done with this. Now, shall we go for risk analysis and real options, or ranking investment projects, or capital budgeting process?
Today we'll complete risk analysis, sir.
Risk analysis.
Yeah.
Okay, then we'll go with that. But I will not be doing all, right. I'll be doing only
Yeah,
eight
yeah, right.
questions
Only few.
because I will leave for you also to do.
Yes, sir, sure.
Yeah. Okay. Yeah. I think after 79 questions, we have this. Yeah. Risk analysis and real options, right? Okay, we'll go ahead with this. Okay, the first question is in front of you. Please go to this. Sensitivity analysis is like if used with capital projects. See, sensitivity analysis tells us about how sensitive the project is with respect to that means how sensitive the project's NPV is with respect to certain variable, project variable. In the sense, if sales price changes, just a second, something. Yeah, somebody can just give me a second. I'll connect this laptop to the charger. Actually, it's almost 2 minutes. Huh?
Okay.
Yeah, yeah.
Eight.
Yeah, so let's go ahead. So the question in front of you is sensitivity analysis if used with capital projects. See, sensitivity analysis checks how the project's NPV gets affected by certain variables which can have an impact on the NPV, like selling price, discount factor, okay, or sales volume, etc. So these are the factors which can have an impact on the NPV. So how
Mm.
sensitive the NPV of a project is with respect to changes in these factors is what we check in the sensitivity analysis. So now coming to the question, if it is used with capital projects, then what is a technique used to rank? I don't think this is what is a blunder, right? So sensitivity analysis is not ranking technique. Of course, it calculates results under varying assumptions. That means if this is varying, this is varying, this is varying, how it impacts NPV. So this is not the answer for this. It is used extensively when cash flows are known with certainty. I don't think when certainty, when you know with that, when you know that certain cash flows are going to be very certain, you use probabilistic approach, not sensitivity analysis, right? When you know that the cash flows are certain, then where is the vary? How the things are varying here? Am I right? When see it is this methodology is used when there is a when things are varying. Am I right?
Mm.
When this varies, how the cash flows are. When this varies, how the cash flows are. When this varies, how the cash flows are. I think sensitivity analysis is not covered in our syllabus. I have some videos of this. I'll give you some. You can try to understand the concept. Shall I give?
Okay. Yes.
Hello.
Yes, sir. Hello.
Yeah. Shall I give the videos?
Yes. Yes.
You go through that, you'll understand what is sensitivity analysis. Okay. So
Okay, sir.
yeah, so when I speak about certainty, that means you know the cash flows are, you know, fixed amount of cash flows are going to come. Then what is varying there? So that so here also sensitivity won't work.
Okay.
Measures the change in discounted cash flows when using discounted payback. Oh, absolutely wrong. Is a what if technique that asks how a given outcome will change if original estimates of capital budgeting model are changed. Yes,
Yes.
original
Yes.
estimates means discount factor changes one of the estimate, right? Correct.
Yeah. Yes.
This is the
Right.
option. If discount factor changes, how the NPV is going to, how is going to impact the NPV is what we see in this. Now, next question. Company has experienced major distribution problems in supplying key customers. Delivery times have been as follows. Sorry. Over the last 4 months. See, this particular concept is like in Hawk, you will not see much of mention. So you have to understand here itself. Okay. So company has experienced some distribution problems in supplying to some key customers. Delivery times have been as follows over the last 4 months. Delivery time in days, 5 days, 6 days, 7, 8, 9, and time number of times occurring. These are the things. Company's marketing manager wants to simulate. So they are speaking about simulation model. I know this also I haven't taught, not there. But I think in MBA you had an exposure of simulation model. There are random numbers, right?
Yes. Yes.
The distribution process by assigning random numbers to delivery times. So they'll assign some random numbers to delivery times and to other random variables. So that is the method in simulation they do. If the marketing manager uses 100 different random numbers to simulate the process, an appropriate assignment of random numbers to a 6-day delivery time would be. So 6 days they are saying. So you know 18 is not lying between these. Is it lying?
No. No.
And sorry. See, the thing is between 9 to 16. See, we have to see how many numbers are lying in them. Number of times occurring. Between 9 to 14, how many numbers are there? Not we are not concerned with this. Sorry, we are concerned with how many numbers are there. How many numbers? 9 to 14.
5.
6 numbers.
Okay.
For
Yes.
6, yeah, yeah. For 6-day delivery, for 6-day delivery, like delivery time in days, we want how many numbers?
18 times.
We want 30 numbers. 5th day and 6th day, right?
Okay.
Correct?
Yeah, right.
So range of 9 to 14 includes only 6 numbers, but we need interval of 30 numbers for 6-day delivery.
Yes.
And range of 30 to 60.
30.
No, if we take here, if it was the case, then only 5 was the thing, right? But why 6 numbers?
Yeah.
You are taking from 9 to 14.
9.
9, 10, 11, 12, 13, 14, 6. So here 31 numbers,
Okay.
right?
Yes.
But we need an interval of how many numbers? 30. This also
30.
won't do. C,
29.
45, 46, 47, 48, 49, 50. So till 50, here it is 6. Then plus 24, right? 30. So this is the answer. 30 numbers.
Yes.
Correct or wrong? This is also
Right.
not. Yeah, next one. It was not that tough, but only the methodology is not known. That's the reason why students get confused. Now it's known, you understood. Go for the next question. When the risk of individual components of a project cash flows are different, an acceptable procedure to evaluate these cash flows is to dash. See, when the risk of individual, see, when you take up a project, right? There may be different kind of risks which a project may be exposed to. Am I right? Is it right or wrong?
Yes, sir. Right.
So what we will do is we will consider all the kind of risks and we will incorporate that in the discount rate. Am I right?
Yes.
The liquidity risk, the solvency risk, the inflation risk, all the type of risk whichever a project is exposed to will be incorporated in the discount rate, right? So option
Yes.
D. Shall I move forward?
Yes.
Next question. A manager who knows the effect of possible change in cash flows on net present value of the project. Now this answer easily you can give. I'm not answering this.
Return on investment analysis.
Please understand, we had just right now had discussion about this. See, your project NPV
Possible
can
change.
get, sorry?
Sensitive analysis.
Yeah, sensitivity analysis just now discussed, right?
Yes.
The project's NPV can get affected because of various factors. So,
Possible change.
yeah,
Yeah.
yeah, change in cash flow sensitivity. Right, next. Fifth question. A builder of custom homes recently invested $360,000 of material, labor, and overhead in a residence for a customer. This is the initial investment. The customer unfortunately had just declared bankruptcy and must back out of their contract. The builder's management has identified the following two courses of action. Sell the unfinished residence as is. The company's sales manager has assigned the following selling prices and probabilities to this alternative. It's a probabilistic approach, right? So the selling prices are given to you if they want to sell,
Yeah.
and these are the probabilities of getting. So they're asking, maybe they may be asking you the, let us see what they're going to ask. That was the first option. Make several design changes at a cost of this, complete the project and sell the home to another customer for this. On the basis of this information, we have to see builder is having benefit in what. On the basis of this information, the builder should redesign the residence for the new customer, because in comparison with the sell as is option, firm is $15,000 better off. That means four options they're asking: either The builder should redesign the residence for the new customer, because in comparison with the sell as is, they will be having this much benefit. Consider $360,000 investment as a key decision factor in selecting among alternatives. Two alternatives are there, right? They can invest this much and they can take decision based upon that and select any one of them. Redesign the residence for new customer, because in comparison with sell as is option, the firm is $20,000 better off. Redesign the residence for new customer, because in comparison with sell as is option. What is this again? Here they are saying 20,000.
No.
Select the sell as is option, because the chance of $350,000 selling price. 4 options have been given. Now, which option you should be taking? So if I take up the first option, right, I will be finding out the expected value. See, whenever they give you this kind of data, selling prices and probabilities, you should find out the expected value. That means average value. On an average, what you're getting. So expected value formula is PIXI sigma. That means P1x1 plus P2x2 plus P3x3. That means your selling price into probabilities. In Hawk, they haven't covered all this. In Gleam, it is there. I'll give you Gleam textbook also today. Okay, Samri?
Okay.
Just multiply and tell me this one. What are you getting in this?
3,25,000.
3,25,000. So if they sell as is, this is what is they are going to get, right?
Yes.
So if they redesign, what is the thing here? Redesign the residence for new customer, because in comparison with sell as is. So sell as is 325. The firm will get how much? 15,000 extra. That means 340,000. Correct?
Yes.
And the firm is better off by redesigning the residence for a profit of 340. Right? So make several design changes at a cost of this, and complete the project and sell the home to another customer. If they sell it for 410, and if I remove 70, what am I getting?
34 lakh.
What?
3,40,000.
That's what I'm getting, right? Extra 15,000.
Yes.
So can I opt for this option? I'm getting extra.
Yes, sir.
I'm indifferent to redesign, right? Either I make changes, or if I if I make changes and redesign, I'm getting 15,000 extra, right?
Yeah.
Correct.
Yes.
Yeah, 2 minutes. Something. See, if they redesign the project, for them it is if they sell it for this much and net the cost, they are getting 340, right? 15,000 extra than they sell as is. Am I right or wrong?
Yes, sir. Right.
So this option is going well. But second, consider the 360,000 investment as a key decision factor in selecting among alternatives. See, 360. See, either if I take any option, I consider anything, I have to spend 360, right?
Yes.
It is irrelevant. Even I take the first one, even if I want to sell as is or if I want to redesign, I have to spend 360. It's useless. It is, I have to spend this. So how come how am I taking the decision? See, am I getting 20,000 off extra or am I getting 15,000 only? If I
15,000.
redesign 15,000 of no use, I am getting 325 wrong. And the selling price, uh, actually, if the redesign is better, right? We have already proved it. Yeah.
Mm.
Sell as is option because of the chance of 350,000 selling price. Where is this 350,000 like given? 350,000 is like 30% chances I have that I'll get 350,000, right? So if there is only 30% chance, will I consider this? Anyone will consider very less chances?
No.
No, right?
No.
Will you put yourself in such situation whereby the probability of getting some selling price is very least? Will you put yourself in that situation? Ideally, no, right? Hello?
Yes, sir. No.
Yeah, no one will put see
Mm.
that much risk. Who is going to take?
Yeah, correct.
Next question. Management of a utility company is considering making a series of investments over the next 5 years to construct a new energy plant rather than commit to the full 5-year investment. So they want to make a series of investments over next 5 years to construct a new energy plant. See, management of a utility company. My God, my kid is crying like anything, so it's disturbing. The man, just a second. The management of a utility company is considering making a series of investments over next 5 years to construct a new energy plant rather than commit to the full 5-year investment schedule on day one. So they don't want to make one single investment. They want to make many investments and they want to construct a new energy plant. Series of investments, nothing but phase wise they're going to spend, right? Rather than commit to the full 5-year investment schedule on day one. Management wants to retain the flexibility in the timing. That means they don't want to put the entire money on day one. They want to put it phase wise. And the amount of each investment in order to take into consideration future business conditions at each stage of construction. Because if they put the entire money, they don't know what's going to happen in the future. So they want to study, they want to put some money and then they want to proceed further. Based on this information, which one of the following real options is most appropriate for this situation? Either they have to abandon. I don't think they should abandon. They should expand. No, they are spending they are spending what they have. They are delaying, right? It's better to do that. Correct or wrong? Hello.
Yes, sir. Hello.
It's better to delay, right? To
Yes.
delay the things and then put money.
Okay.
Hello.
Yes, sir.
The opportunity is not lost. They want to continue the project, but with somewhat delay. Scale
But
back
not
is
on
what actually
one day.
yeah, they don't want to reduce anything here. They want to put their money, but they want to do it slowly. Okay.
Delay.
Mm,
Okay.
yeah, yeah. Next question. It's Monte Carlo simulation based question you had in your in your MBA, right? An analyst plans to use a Monte Carlo experiment to simulate daily demand. Probability distribution for daily demand for heaters is as follows. Daily demand of heaters is given. Probability is given. Random numbers intervals are given. What are they asking? The analyst is trying to assign random number intervals for each of the demand levels. She has done so for the first 4 levels. If a total of 100 two-digit numbers are used in a simulation, so 100 two-digit numbers, they like you can take anything, right? 10 to 20, 10, some numbers are given here, some intervals are given. What random number interval should the analyst assign to 4 and 5 heater demand levels respectively? This and this. Because for this random numbers are not given. See, they have given the random numbers for all, but for
Yeah.
this the random numbers are not assigned. Actually, in today's world, system generates all this, but they're asking this manual thing to us. So what to do, we'll see. See the interval 65 to now. See, you can see here 0 to 9, 10 to 24, 25 to 44, 45 to 64. Then it will be 65, right? Correct.
Mm. Yes.
And 65 to what shall we do?
80, 84.
Just a second.
Right.
Yeah, see the differences between them. 9 difference, 14,
9,
and here
19,
and here
19.
19, right?
Yeah.
So if I see the probability, I see 0 to 9. If I see 15, I see 14. If I see 20, I see 19, right? 19, right? Then it can be
Yeah.
24.
Yes.
So can I put
Yes, sir.
here 89? 65 plus
Yes.
24 is 89, right?
Yeah, right. 20.
And then 9, I shall keep the difference, right? So I can
Mm.
take like 89. I have taken 89. So next will be 90. Is it right? Then 99. Can I put 9 difference? Is this the random numbers I can pick up?
Yes.
Right? So this is the
Yes.
answer. This is the answer.
Mm.
You can do this.
Intense.
7 questions done. We will do the last question and then I will give you the opportunity to do the next questions. A company wants to use discounted cash flow techniques when analyzing its capital investment projects. Company is aware of the uncertainty involved in estimating future cash flows. Simple method some companies employ to adjust for uncertainty inherent in their estimates is to adjust the minimum desired rates of return. This is not there. Prepared at not there. Yeah, see, uncertainty. See, probability prepare a direct analysis of probability of outcomes.
Uh,
This is but not a simple method, it's a complicated method, right?
mm.
They're asking simple method. Probability you are assigning probabilities and you're estimating that your cash flows should be at least some percentage. Like if I say 30% chances that I shall get 1 lakh. So, but the method is lengthy and not a simple method. Increasing the estimates of cash inflows. How come? If you estimate cash flows, it can create errors, right? See,
Yeah.
uniformly increasing the estimated cash flows or ignoring salvage values introduces error into capital budgeting analysis. Correct? Company uses this technique when analyzing companies aware of uncertainty involved in estimating future cash flows. They are not able to very much estimate what the future cash flows are going to be. uh, and that uncertainty they want to adjust. That uncertainty they want to adjust in their estimates. So we have seen use accelerated depreciation has nothing to do with this, right? This is for tax purposes we take, right?
Yes. That's it. Mm.
So we take this for tax purposes, and in every capital project we take this to minimize taxes in early years. This is related to taxation. This is like direct prepare a direct analysis of probability of outcomes. I already told this is not a simple method of adjustment.
Yes.
for tax purpose, right? I understand tax is also something you will be getting benefits on that, taxation benefits. But we are doing adjustments. So increase estimates of cash flows and adjust minimum desired rate of return. See, uncertainty can you see if you are having uncertainty about certain cash flows, what you can do, you can adjust your return required rate of returns, right?
Yeah.
See, if you think that your projects have very uncertain returns, a higher rate would be required. Why? Because there is very high risk, correct?
Yes.
Lower rate is acceptable when there is greater certainty, right? So the
Certainty. Yes.
concept is that when increased risk should have increased rewards and higher rate of return. So if there's very high risk, you can try to adjust your returns to a higher to a higher level. And when there's low risk, you can put your returns low. So you can adjust this, right? It's very simple to do even, right?
Yes. Just the minimum desired.
Yeah,
Okay.
and here what is happening? Uniformly increasing the estimated cash flows. If we increase the cash flows and it at times or let's say or we ignore salvage values, let's say, or we ignore certain things, then it can create error in the capital budgeting analysis. It can be erroneous at times. Okay, this is what is very much going with the concept. Every investor would increase the returns if the risk is high and decrease if the risk is less.
Yes. Okay.
So rest of the questions you have to do summary. I am
Okay,
leaving
sir.
this
Okay.
topic to you. Yeah, you want any other topic to be taken right now?
If it's possible, you can take the 10 some few questions.
This is done. Yeah, this is done. This is done. You mean to say, if possible, we have to take ranking 10 questions?
Okay.
So, no, just saying. It's 5, 4, 5:30.
Yeah.
Okay. Let me check. Let me check and confirm you that. Okay. Just give me some time.
Okay.
5 minutes. I'm just confirming in 5 minutes.
Okay.
Yeah. Yeah.